Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stocks in limited quantity, but many are still outraged over popular trading app Robinhood's actions when the company allegedly protected big traders from losing money to small-time investors by blocking stock sales.
What began as a social media skirmish has exploded into a debate in Washington and on Wall Street over who makes the rules and whom they apply to.
They call themselves Robinhood, which, I mean, take from the rich and give to the poor. They did the exact opposite today.
Thursday, discount online brokerage Robinhood barred users without warning from buying new shares of GameStop. In recent weeks, small investors, driven by momentum on the Reddit forum Wall Street Bets, have sent the stock price soaring by over 1,600%. Critics, including Barstool Sports founder Dave Portnoy, who himself owns GameStop stock, allege the brokerage did it to protect hedge funds and other Wall Street institutions, hoping to profit by betting against the company.
What if they say, look, the valuations of the stock where the price was, it just wasn't sustainable?
Nobody's going to debate that the price of GameStop or any of these others were fair market valuation. Everyone has skin in the game. But now, when the retail guy, the everyday Jimmy and Joe, when they're winning, suddenly the rules change.
But Robinhood CEO Vlad Tenev denied any foul play, saying the move was aimed at protecting the firm and its users.
We absolutely did not do this at the direction of any market maker or hedge fund or anyone we route to or other market participants.
Lawmakers from Democrat Alexandria Ocasio-Cortez to Republican Ted Cruz have blasted Robinhood over its GameStop trading freeze.
I think the forces that regulate the market, whether Congress, more importantly the SEC and the exchanges, need to understand these dynamics.
Jacob Frankel is a former SEC lawyer. He doesn't think new regulations are required, but does believe the industry must adjust to its new reality.
What does it mean for the future of trading?
It means that the SEC and the markets, in some respects, need to recalibrate. The markets are looking at something that they've never experienced before.
Robinhood says it will continue to monitor the situation and may make adjustments as needed. Faced with a high volume of trades and demands for cash, the company announced last night it raised more than $1 billion from existing investors, which it called a strong sign of confidence. So for more on this, let's bring in CBS MoneyWatch senior reporter Stephen Gandel. Stephen, so firstly, I think a lot of people may not understand some of the mechanics that are at play here. So explain to our viewers what short selling is and how it works.
Sure. Short selling is the mechanic, the instrument that a Wall Streeter, particularly usually a professional Wall Streeter, uses to make money off of a stock that's fallen. So what they do is they borrow shares that they don't own and sell them, hoping that the stock price will fall down so they can actually buy the stock at a lower price. And then they get to pocket the difference between what they short sold, that's what the name's from, they didn't actually have the shares, the difference from what they short sold the stock at and from what they bought the stock, hopefully lower. Now, when the stock goes up instead of going down, that creates potentially unlimited losses for the short seller. And so they have to quickly find stock that they don't own, right? They were short the stock. And when you have a situation like we had with GameStop, where it was the most shorted stock in the market, pretty much every available share was shorted, it's nearly impossible to find those shares. And what you have is a short squeeze. Sometimes you have something they call an infinity squeeze. That means they just can't find that stock. They got to promise higher and higher prices to buy it. And that's what you had with GameStop. You have a stock that just takes off.
So, Stephen, short selling has been around for a while, and you can probably sort of correct me if I'm wrong, but as I understand it, it can often be used when you're dealing with stocks that have kind of natural seasonal fluctuations. Maybe, it's a type of business that goes up and down, and so you can sort of ride it. But it's taken on this feeling that, in fact, what these analysts are doing are sort of like dancing on the graves of, or the impending grave of a business. And this it gives people a bad taste. Why is it attracting so much scrutiny now?
Well, just for what you're saying, short selling has kind of always given people a bad taste. In the financial crisis, we banned short selling in financial stocks because the thought was that was adding to the crisis. There has been a number of instances where short sellers have been very positive. They've pointed out frauds coming from China. Enron, if you remember, that was something that we found out because short sellers started to point it out. It's good to have information on both sides of the market. The problem may be that a lot of these short sellers were essentially getting free money because the trade that they had was that retail's going away. And retail may eventually go away, but GameStop is still around. Yes, they closed 1,000 of their stores, but they still have 4,000 stores. And so the hedge funds were just kind of booking free money on this idea that retail is eventually going away, so it doesn't matter. And all these these individual investors came in and said, wait a second, why can't we get some of this free money? And so they've disrupted this kind of easy trade for hedge funds. And that's kind of what the market does, right? There's arbitrage. They arbitrage free money away. The unusual thing is usually this is the other hedge funds or other banks doing this, high finance. Instead, it's driven by social media and average investors who are taking a page from the financial types.
So in my reporting, I spoke to Dave Portnoy, who's the founder of Barstool Sports. I also spoke to Jamie Roginski, who is the founder of that Wall Street Bets subreddit group. And you could hear in Portnoy's tweet, he was pretty fired up about what he thinks happened with Robinhood. And then you saw, I think he made a joke. It wasn't in my piece, but at the end, he sort of made a joke that, the fact that you've got Alexandria Ocasio-Cortez, Ted Cruz, and Donald Trump Jr. all in agreement on something that they should be looking into what's going on with Robinhood was fairly, interesting to him. He believes, and I think he articulated what a lot of these smaller investors are feeling, which is that Robinhood prevented people from buying the stock so that the big hedge funds could get out of their positions before there was a major margin call. What is your take? We don't know that actually happened, and we've got a statement from Robinhood, which I read in my piece, but what do you think is going on there?
So I think Robinhood does have a fairness issue, right? It does seem unfair that individual investors can't do whatever they want and hedge funds can. But what they did was restricting buying. So are we upset that hedge funds can buy GameStop at $500, which everyone agrees is a terrible investment, and that individuals can't? I mean, the problem is that Robinhood, and this is what regulators need to look at, Robinhood has enabled average people by making trading free, right? I mean, part of Robinhood's problem is that the thing that makes their trading free is that they give a lot of their information to hedge funds to trade on. And so they're caught in this situation where if they now say, oh, we're all for the individual investor, their product has been passing along this information to hedge funds. So they're conflicted from the start. So you have an issue where you have these people who've been let in to this stock by Robinhood, and it seems unfair for Robinhood now to cut them off. But I think Portnoy's wrong in saying that by stopping to allow new people to get into GameStop, you're not being Robinhood. When you let someone get in at $500 who are going to lose their money eventually to the hedge funds who are shorting it, you're also still giving those people's money to hedge funds.
Just so, because everyone knows, because we were talking about this tomorrow or yesterday rather, I'm one of those Robinhood people, and I think part of the frustration too was that they didn't really articulate what was going on, and so people had gotten in, they were waiting to see their stocks show up on their list, and they didn't materialize, or they took a while to materialize. I think that was probably a hard lesson that they learned there. But I want to ask you, we're making a big deal out of this over the last couple of days. It's sort of shocking what was able to be organized on a subreddit. But does this signal a bigger shift, like a boost for retail investors and a shift away from these big Wall Street firms? Or is this just sort of like a little speed bump? It's kind of interesting, but things will go back to the way they were before.
I think that there are certainly a lot of institutions here in place to clamp down on this kind of stuff, like what we saw with the depository trust saying that, hey, wait a second, Robinhood, you've let too many people into this stock, you've created too much volatility, we're going to make you have more margin. So there definitely are institutions that will rein this in. What we've had this before, we've had day traders in the 90s pop up to take away the inefficiency of market makers and Wall Street firms getting a very big spread when the stocks traded. So I think that's the same thing. There's a time here where hedge funds are making money, free money, that they probably shouldn't be making, right? That money should have been made by average investors in index funds. And so I think what you see here is some of this money that was, we thought the hedge funds were making because they're the smart money, right? Some of that, those unfair gains are going to be sucked out of the market and hopefully more widely distributed. So I think that's a positive change. But I think we're also going to have to look closely at some of these options markets and derivatives trades, which seem to be behind a lot of extra volatility. And we're going to have to look closely and say, okay, do we want people piling to these markets? Does this create more volatility? And if at the end of this, does it create more losses for average investors? And also, we need to look at social media. And if people are using bots or if hedge funds are hiding behind the anonymity of Reddit, then we need to look to see that there's not market manipulation in places that we haven't looked before.
Yeah, it makes a lot of sense. I mean, at the end of the day, the other point that Portnoy articulated, which is there are people who are part of this subreddit group and other small retail investors who understand the risks, and they want to be treated exactly the same way the institutional clients are treated, in the sense that they want the fairness of the market to apply equally to everybody else. When you change the rules mid-game is, I think, the biggest complaint, that they feel that Robinhood, out of the blue, Anne Marie's a client, all of a sudden you wake up and you check your app and you can't execute trades, but others who are more powerful than you, who have more money than you, can. Many people feel that that's unfair, and that's why you've got all these different members of Congress looking at it. And we'll, this is not over by any means, and it's a fascinating story because there are just so many different layers to it. It's not just a Wall Street story. It's one that pits David versus Goliath. It's one that talks about these new trading platforms. I thought it was interesting. I was telling Jacob Frankel, the lawyer, the former SEC lawyer that I interviewed, that when I first started in 1991 as a young stockbroker, the notion to me back then that young people in high school and in college would be trading stocks was like unbelievable. It was so misogynist in back when I worked in the early days of my career on Wall Street, that my boss, I'll never forget, he told me that if I called a potential client or even a client and the wife answered, that I shouldn't have a conversation with her because she wasn't the one to talk to about investing in stocks. And now clearly that misogyny is no longer a part of it, and now you've got democratization of stock picking and trading, which is, I think, a great thing. But there are these pitfalls, and that's why we're talking about it.
Yeah, no, I think Robinhood's got themselves in a situation where there's kind of no win. But I think in the future, regulators have to look at these markets, whether margin was allowed to be spread too widely, given out by Robinhood too much, whether Robinhood should be able to. I mean, the whole market is based on this. You can trade for free, but your information's being shared with hedge funds who could potentially trade against you. Whether that model is positive for the market. But I think you're right. I mean, generally, things have moved in the right direction. Things have gotten more democratic in the market, and we've allowed individuals to do more things, have access to what used to be, the old boys club. And that's good. But as markets change, we need to look at them and say, okay, does the options market, do these leaps options, which is what some of the Wall Street bets people were playing in, is there enough liquidity in this market to allow every individual investor in? Or if we do that, are we going to create more volatility and in the end create more losses for people and make the market look more unfair? I think regulators need to look at that. It's not going to help the people who are in GameStop who might lose money on it now, but maybe it'll help before the next bubble happens.
Stephen, always great to have you, my friend. Thank you for a fascinating discussion. We appreciate it.
Thanks. Nice to see you.
So let's